Greetings, market rebels. Welcome to this week's sector situation. It is Sunday, August 6, 2023. It's a little bit after 1:20 p.m. on the East Coast. I'm Wayne, my partner Ryan's wrapping up our market outlook overview that will be headed out, which will include links to this video, of course, and macro measure, which was quite a long one, but I apologize for that. But it's just the way it had to be this week, I think, given that we may be at a critical turning point, and there's a lot of good reasons for that, I think, as well. But anyway, let's get rolling. Let's get things, making sure we're on the right screen here. And let's see, we are, make sure everything's good to go. And let's just flash our trusty disclaimers. Please memorize that. And then also quickly memorize the intellectual property rights notice for us. And then we will, we'll get into just the flashing of what I used from macro measure for this week. So there are quite a few updates and kind of hitting on a lot of things we've talked about recently. And just if you want to take a snapshot of that, and you can put that off to the side on another monitor or something. But that's kind of the backdrop of so to provide the context right on how we're discussing things. So you can look at macro measure, jump ahead all the way to the charting phase of it, which is probably somewhere near the halfway point, I would guess. And then if you don't like that, you like the idea of just catching up on a lot of the news we think is important right now, you can take a look at the initial part, which has quite a few tabs this week, but that's just the way it is. So on that note, let's kind of break free, stop sharing, and I'll reshare very shortly. Let me break free from having to flash that. I'll put this up over here and we'll use it if we have to, but I think we're going to just get into, into the charts, because we just kind of go right to the charts and sector situation. And usually, we start out with the sector grid view, the grid of 12, as I like to call it. And I hope that's here, and there it is. So that's the one. So I'm going to just briefly start here, and then we'll move into reviewing these kind of, on their own. Clearly, right, a lot of the stuff we've been talking about macro-wise, keeping it on the back burner, that I think started to assert itself, or maybe the market decided to recognize that a little weak. And I think you can see, just as a quick glance here, that a lot of the overbought RSI readings are gone. The only thing really even approaching the 70 on the daily RSI right now is the XLE on our grid of 12. Some of the leadership sectors like XLK, for example, XLC, they may still be holding trend, just as the markets are holding trend in the form of the SPY proxy or ETF proxies, the QQQ. But right, it's getting a little dicey, and again, we think it should be getting dicey finally, and it may seem to be doing that just on time. So very interesting how this year has played out, very much like the prior third year of the presidential election cycle. But a lot of things cooled off the last few weeks, A lot of things are away from overbought. A lot of things are obviously middling, right? There's a lot of things near the 50 reading. And we have a very few sectors that we could say are really looking promising at the moment. They'd all have to find support, which some of them are right near it or right on it. And then they'd have to start trying to rally from there and see what they could do, So that's the quick view. I think of what we can draw from this. And I did add some support lines again, because I think we're at potentially a critical juncture, a juncture that at least to me would make a lot of sense to correct from further. We shall see, as always. That's the cool thing about the markets. You get to at least see if your takes pan out or not, and for what reasons they don't or they do. A lot of times anyway, at least you can guesstimate. But I think really like the lone survivor really at the moment where I would be thinking about, yeah, let's stay bullish. And this has to do with some of the graphics I flashed in the first video earlier, that macro measure, that is because oil really, with I think the info that we came across with reserves as the lowest they've been since 1985, 3.5 decades ago, nearly 4 decades ago, that just tells you how low reserves are. And so that could be an issue, and clearly, right, that could be affecting oil. And that means, right, it's an independent sector at times. And so it could certainly remain independent, and independently it could rally even despite equities correcting. Maybe if it rallies, it actually worsens the situation in equities, because the implication would be that gas prices keep rising and the consumers already not nearly as well as the usual suspects, the permeable camp, I think would have most of us believe, in my take on it. So that's just a quick view on things. There's not a lot that we can say like, hey, this thing is emerging, right? What I'm seeing really more is a lot of sectors that rolled over, and therefore you have to conclude you started to see at least the start, of a risk off phase that we've been talking about for a while. When would it come, right? It made sense for it to come as August came in and July went out. So this is the time you would expect, and it's right there. I mean, you can see a lot of these sectors are right on support or right near support, just basic trend line support in the intermediate term trend lines. I guess we could call them, really not the long terms. And a lot of them have gotten near the 20 SMA, which was a big deal in the macro measure video the past few weeks in terms of the SPY and the QQQ. So I think, right, it all kind of makes sense. The only issue I think we have now is, did we finish the week maybe a little bit oversold or close to oversold? So they never really seem to make it easy on shorts, on bears. Even during vicious bear markets, there's incredible rallies. We can go back to 2022, look at the major index ETFs like Qs and SPY, and you'll see that. But this is really more about sectors right here in sector situation. And I just think it looks like a risk off phase developed. Now, that's the big question, of course, is since we're near support, and we have corrected, do we just correct a little bit more, officially become oversold? We're not quite there, and then that's it, right? Or is there more to it? And I think that's really going to become the big question. Did we see a tremendous bear market rally in SPY and QQQ, and now we're actually on the way to another phase of a bear? Or, right, was this the start of a new bull? We're going to see a corrective phase of the recent bull run from the October lows, and then we're going to go from there to put in a higher low in the market relative to there, and then we'll start rallying again. And so that would be how the third year of the presidential cycle has it. And next year it happens to be the second best year typically in the cycle of the presidential cycle. So that would be the outcome, right? If this cycle keeps tracking as well as it has through 2023 so far. And really from the fall, actually, the sweet spot of the cycle starts in the fall when it did, and it lasts until really when it did. So this, again, that third year sweet spot we've talked about so many times in the webinars, newsletters, cocktail hour, I mean, everything, right? All the videos we've done for most of the year, that's really been a winner, right? To keep an eye on that. Not that you trade according to it, but it's kind of amazing that how it's been able to deliver at the right times for, and maybe to a greater extent than would have been suspected. So because I haven't really bought into this bull story, the various bull stories they've been floating, this to me is starting to make more sense. And I'm not really, I'm not a perma bear, and I certainly don't trade in the way of my macro takes, and we don't suggest that anyone that follows the services do. We rely on the technicals, despite what our opinions are on the macro side. But I think that there really should be more of a risk off phase. And so I think a lot of things here, the big question for me is not, will they correct further? I think they will. I think the odds favor that. I'm not predicting that. You know how I am. I more about saying, I think in most scenarios I've seen, you would see more corrective action normally from where we are now. But my big question in the short run is, do they bounce them a little bit first after maybe they get a little bit oversold on Monday and they reverse things maybe late Monday or Tuesday, and then we get a little bit of a relief rally and then we see what happens? Or, right, is it just straight down from here? Now, the way that the dollar and treasuries acted, that is quite interesting, because those are macro discussion things normally, but it's worth covering them here because I didn't do it in macro measure. And this is really, to me, been part of the reason why, along with, right, the earnings not really being bought or jammed, more of a sell on news earnings scenario played out, which we were wondering what would they treat us to. That's what they did treat us to. But here's the recent resistance line in the dollar, got right to it pretty much, right, and held there, but then started rolling over on Friday. So that backed off a little bit, but the market, of course, did not finish very well, kind of closed ugly. Excuse me. Long-term trend of the dollar still down, but right, do they find a way to put in a higher low relative to the lowest low that we saw back in July, and then try to, again, I call it a base camp. Do they try to put in a very brief pullback and then take the overboughtness out of it and then go up and through? And my argument is, just thinking about it, is that there's a lot more gas in the tank to really get a breakout going. If you have a mild pullback, hold most of your gains, maybe churn for a little bit, excuse me, take the overboughtness out, and then you haven't spent so much energy working up to your resistance level that you can find a way to go through the second or third time you try. Anyway, that's just my 2 cents on it, but that's one scenario I would keep an eye on for. I would expect there to be a little bit more of a pullback here, but you know, again, I'm not really charting the dollar in a big way here. I'm just kind of suggesting that that is part of the problem for the market. Another big problem, I think, for the market is yields, and the fact that maybe yields continue to try to rise overall, and the fact that yields maybe stay up longer than a lot of people think. And here's the 10-year yield. Again, we normally do this in macro measure, but I'm doing it here. And you can see that you get the false breakout. We talked about this on many things last week. You're back towards this 42-ish high. You got to 41.98, pretty darn close. And then you backed up from there. And that's, I guess, after the run it had, right? That's pretty much to be expected. Let's get a little more time in here so we can check it out a little bit longer back, a little bit further back, excuse me. But on this one, right, look at the RSI that day. It was really only, don't look at this label, look at the RSI down here. So that got up towards 70, right? It was 68 and change. So yeah, it was approaching overbought, right? And it was a great week for, you know, I think bears, and especially dollar bulls, equity bears, and yields did track along. But now, right, again, I wouldn't be surprised to see a little corrective activity. So I'm wondering, does the gang sort of gap things down a little bit or make it look kind of ugly somehow on Monday morning for a while, and then eventually they try to put a relief rally in? Because I don't know, I think without news, it would be unlikely for them to instantly crack support in all these sectors. Then again, right, that certainly could happen, but I'm thinking usually on the first test of support in a market that's been acting as bullishly as the one we've been in now for 9 months, that typically isn't the case, right? You normally don't crack without a good reason on the first time. You can crack, sure, but not normally on the first time you test it. It usually puts a little, there's usually a little bounce that gets manufactured, and then you get another rollover that takes you through, or a second consecutive rollover after that that takes you through. But there's your 200 in the VIX. Not that we can chart things that way, but you can see that it's been a while since the VIX was able to really spike above there. And usually, right, you kind of do have these prolonged subdued periods. We've been talking about the VIX and saying, like, look, we've been saying actually for several weeks leading up to this that you might want to get yourself involved in Phoenix portfolio service, or at the very least, if you know how to position yourself with long volatility, now's the time. And all you really have to do is go check out the one tab that I flashed. I think that was from Tavi Costa. And you could see that, right, it's the right time to position yourself that way, according to the VIX seasonality and the vol cycle itself, just year to year. So year in, year out. So with that, let's move these sectors off the screen. And what I'll do is take a look at each individual sector, and we'll see if we can draw anything from here. So XLE is our first one, I say, to Thinkorswim. This is probably, right, the shining, sort of shining star at the moment, because it's been able to largely resist the selling that we saw. I mean, it put a new high in on Friday, but it's right at a resistance line of mine, right? That one line is pretty stout. It goes way back here. Probably not perfectly drawn out. Well, it's not terrible. But anyway, the point is it's near one. It doesn't go through. Look, it's in a little channel. I like to always try to put a channel together. I feel like when you look back on stocks, a lot of times channels really make a lot of sense. It might not be so easy to draw them in real time, but channels to me are a big deal. Anyway, I find them helpful. Anyway, that suggests to me that if they do break out here, right, the kind of trajectory would be, if it's very aggressive in the short run, it would be towards a 91 and change level. So there could be a very forceful move that still keeps coming. Now, just for the record, these standard deviations on this particular layout are set to plus and minus 3 standard deviations for the Bollinger Bands based off of the 100 SMAs, just so you know what you're looking at, whether you believe in that, you give it any credence at all. I do, which is obviously why I keep them on my charts. But right now, right, the RSI label can help you if we're not looking at a different date than today. That's 64 right there. So that's probably because you corrected, right? It was probably a little bit higher intraday for sure, but we had that kind of reversal there. And really 63.5 it was on, excuse me, on Thursday. But yeah, I mean, that you can see that's looking better than a lot of them. It hung in there. If you wanted to go short that thing, right, you could start making the case, well, there's an RSI divergence or this, that, and the other thing. I don't disagree with you. I think you have to really dial into the specifics in that market, though. And so maybe there is a little short-term double top, you know, almost something like what people call like a tweezer's top or tweezer's bottom. Maybe, you know, maybe you come back to the 200 and you test, which is down, you know, near 85. So I would keep an eye on that down to 85, maybe, and then see how it acts if you decide to be a really aggressive short. But overall, the intermediate term trend is still up in my mind. So, and again, I think it can act independently. The only other thing that really kind of, I think, was besides transports that was doing really, really well, and maybe along with industrials, that was the XLF. But I think you could see that's now vulnerable. You know, you look at it on the bigger chart that we've got here, and that appears vulnerable to me. So I'm not sure why some of my drawings aren't showing up on here. I thought that this was linked, but it might not be linked. So given that it's not linked, what I'm going to do is just add one here because I think it makes sense. So we can see where the trend had been. This really, right there, is a good line, I think, relatively good. You can see that it mattered after we fell through it. That was the high. This day, they took it all the way back up on Friday, nearly dead on the line, and then reversed. So that's sort of confirming for me that my line matters. And that's how I do it anyway. And as far as my line mattering, why is it important? Well, that means you really have lost this trend, right? That I'm trying to find the right word. That this dynamic has shifted. So the dynamic shifted. Now I think that really tells me you really have a high chance of being in more of a corrective phase. And so, you know, again, I would think a visit to the 200 wouldn't be crazy if this market continues to go risk off. So I would keep that in mind there. Now I would start thinking a lot more highly of this if it worked its way back above trend, right? But for now, again, I've been saying the last couple of weeks, singles, doubles, be nimble, be disciplined, right? Discipline dictates action. Get yourself through these areas that have been, you know, when you get singles and doubles, you get the choppy market, the volatile market. You really have to be more quick to react, not go for the gusto the way you can in a roaring bull phase like we had, or some stocks were just making incredible moves. So another thing, right, that we should look at, we'll work our way down like half of our names, the technology sector. And I don't want to belabor all these, but unfortunately, I might have to draw a line on this. I think I'm going to let it go because just in the interest of time, but I think what you'd see, actually that line showed up. And so what I would do now that I'm on a little bit larger of a view with this line is fix it, because I dropped all these lines on the grid of 12. So let me get this, and they're much smaller. This to me would be down about right about there. And you can see that's really where that trend is. So that would be a sign of look, technology is really cracking. And I could probably find other gaps if I really went about a gap hunting. So to me, right, losing that 50, this is where it's getting to be a big deal. I think if you lose that support line that I just added in there, let's just put a ballpark number on that so we can just get a general sense of it. I don't know, call it 160. Let's call it 168 just to have a round number. So somewhere near 168 gets you there in terms of cracking the trend. But remember, you could come down here, and they're great at doing this, right? Make it look horrible and get an RSI reading that's on the daily that slides from 42-ish into the 20s, get it oversold, and then try to put a little something back together to touch the underside of the 50 or fight their way back into the channel. Could be just a scenario. I mentioned that because it's very common, right? It happens a lot, especially when these guys are playing games and they need to work liquidity magic for themselves. They're able to pull off a lot of things. So right now, though, hard to like this, right? Given that it's rolling over, put a lower high in prior to rolling over, and the short-term SMAs are just about all rolling over. The 50 and the rest of the longer terms are still upsloping as you'd expect, because we haven't seen that much damage yet from the highs, but you're getting there, right? I think you could have a little bit more selling. And then I think, again, I'm not predicting it. I just think know where you are, right? And just be careful that if they do start this week out ugly, I would, without like a really serious news driver, I would expect them to shortly thereafter put together really a scam rally that they manufacture, because you'll be getting close to oversold or maybe even oversold at that point. Depends on how it plays out. Anyway, that's XLK. That's been a leader, not leading so much. XLC, right? This one to me is on the verge. You can see it's right on the 20-day. And so this has also been a leader. Notice that the RSI is really tailing off here, down here with this line, the white and red line. And so you're not cracking trend there. I'm not going to draw a line, but use your eye just to draw one. And you could see that this could certainly roll over. I think if you take that low out, you're the 65.34, excuse me, you're definitely very close to this line here at 65.34 is very close to the 50. So that would be a spot where you would think there'd be really a big test. And if that doesn't hold, the 50 and that low-ish flat line or support level, you probably start looking towards the 100. And remember, there's still, I think this gap is unfilled here, just for starters, right? So there's other ones probably too. So just be ready, because I think you can see a lot of these sectors look similar that had been leaders. And so that, to me, again, with so many of them looking that way, that's risk off when they sell almost every sector. The only sector I think that was up on Friday in positive territory was energy, and that's what confirms what we've been saying about its independence, right? And what's been going on there. Right on support line, I mean, I could draw this a little bit better, but you get the idea. And you can see there's nothing really below the support line in terms of the SMAs. They're all basically above, right? And you're at 38.5. So yeah, could you fall a little further? Yeah, you could, right? And so on this one, I mean, this to me is a big area that's definitely defied my expectations, and also defied, I guess, gravity and to a lot of people's take on it, not just little old me. But this XHB, this one is obviously related, not exactly, but you get the idea. And that is also right on the 20, which is key. And you can see there's a pretty good spread between the SMAs. So they're not going to be of great help, right, to support this market for a while. And so if you get through that one, then there's a lot of space there. And really, that's what you want to see as a trader. You want to see areas where there's a void, right? I call it a clearance zone, where there's just not a lot of previous price action, price structure to support stock prices, nor are there SMAs, right? So there is some structure naturally in here and there that you'll have to contend with. I think that's a very obvious area right there near 77, should you get there, excuse me. But it all depends on the state you're in at the time. It all depends on if you even get there in the first place, assuming that, right? It all depends on what kind of news is out there, what's driving things. If rates are really ramping, I think people will finally get the idea that, look, inflation, housing market madness, again, right? That seems to be the modern way, the last 20 something, maybe quarter century, really. That seems to be the modern way that these guys rig the economy, and then turns into a mania. And then, of course, the people that are not seated properly when the music ceases to play, they're the ones that get hurt, over leveraged folks. And I think, right, with prices getting jammed on inflation, there was all kinds of inflation built into that, demand inflation, or whatever you want to call it, push inflation, blah, 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 and really monetary expansion inflation that drove everything. You get the idea. Pricey homes at pricey interest rates, and at times where the consumer overall is not feeling so wonderful, tapping credit like there's no tomorrow, as a lot of my friends used to say. Yeah, that's not a good combination. So it's been, but there's a time and place for everything, and that looks rough. And we also have been looking related to that, right? We looked at the yields backing off, but intermediate trend still up, and cut and wood, right? These are your ETFs because we can no longer get the lumber futures that we were able to use, for a while with Thinkorswim. And so these have kind of potentially put that lower high in after failing to break out in a big way. Now, if they come back to the 200, they're in purple, and that doesn't hold, right? That's really a failed breakout attempt and not a good sign, I think, if you're a bull. But it's not there yet, right? That's jumping ahead. So far, it's holding above there. Let's give it the benefit of the doubt for now. But I think, right, we did see some paper in XHB. I did put an idea in there in XHB. So we have a bearish idea in that one recently in UOA Pro. And for that reason, I'd keep an eye on it. It definitely, to me, I'm not a big fan of counter trend trading, but I will show a few names this week that we put in because we thought it made sense. I always couch things that way to treat that accordingly, something along those lines. But, at times you got to step in. I think I've been around this stuff for a long time and traded it in different phases. And there's times where I think counter trend trades make more sense than other times. And this to me is one juncture where it really did make sense to put one in. So we'll get back to some of those counter trends in other sectors. Right, XLV is more of a defensive sector. We were trying to look at that to say, can we get some names in here but you can see that didn't work. That didn't work. It's holding on the 200 in purple, and it's kind of above that downtrend to a large extent. But it's been under pressure now for 2 weeks. The only good thing we can really say about it is that it has corrected nicely. It starts turning up from here. It could mean that there's maybe more defensive positioning because people are realizing that they got too offensive with their positioning based on hogwash, right? Shenanigans, the stories that were being spun about the Fed pausing and reversing soon that just have not materialized whatsoever. That was being promulgated about, I'd say 4 to 5 months ago. But anyway, excuse me. If you lose the 100, right, you're all the way back down, you're below, you're in trouble, right? That 100 is the dashed white line there. So again, keep your eye on that for that reason. This could be interesting in that if it finds support here and starts to go, there could be a whole nother leg. And that would mean maybe the market's just some parts are hanging in there that are defensive because people position that way. Other parts are not. Like, for example, the former high flying winners. So just keep an eye on that for that reason. Another one that can be looked at defensively, especially against its counterpart XLY, would be XLP, the staples. But you can see they came to life lately. We were very fortunate because UOA showed up in some names, and we had some ideas in Rebel Pit that were based on some staples. And they did have a nice little pop there finally, kind of after triangulating for a while. You can see that. And that happened about 3 weeks ago. But now we're right back down to just below really the whole breakout level on a flat line basis, at least. So you got a couple longer term SMAs, including the 50 and 200 that are bunched up there, right? There's confluence there. Does it come back to there and hold or not? But if it doesn't, right, again, revisiting, it would be another lower high, false breakout attempt, not good for the economy type of a look. But then again, it could be that good if XLY is being bought very aggressively, right? So if they rotate out of XLP, but XLY is doing well, that could be telling you that, hey, things aren't that bad. We're going to keep running with the story. And remember, the third year that we're in right now, I keep talking about it, but that says we have a couple of really rough, volatile months in front of us. August, September, maybe October. And then towards the end of the year, things end up rallying fairly strongly. And next year is a good year. So just, you don't want to lose sight of all this. It's just something to keep in mind. Who knows, maybe they want to close this gap in XLY before they let it fall. This to me was all about Amazon, did not close strongly. I think it was an anomaly. I think, I'm not an expert on this at all. I'm not sure what I am an expert in, but I'm certainly not an expert on this. But I think Amazon Web Services was a huge part of their, the beat, if you will. And I'm not so sure, right, that that's really what people are, overall, that's what people are investing in when it comes to Amazon exclusively. And so how is the rest of it? I don't know. I think I would have heard about it if it were awesome, that the consumer's on fire. that story would have been out there. I don't think that was the case so much. So again, I don't think the Amazon, the fact that it was able to mask problems in XLY, have XLY close up, my apologies, this is another one that closed positively, along with energy due to mainly to Amazon as a component. We talked about that on Cocktail Hour, I think, or at least one of the webinars on Friday. And so short term, there's gaps in both directions, longer term gap there. Again, to me, right, this thing was deteriorating in terms of its technicals for a while. This to me was more of an anomaly. You never can rule anything out. I wouldn't be shocked if they found some way to close that gap in the short run. But to me, I still think more corrective action comes in here because the stuff I've been reading suggests that, right, things are not well. And again, credits being tapped at some of the highest interest rates ever and for the longest terms ever. And also credit card balances, the whole works. People are just doing what they do and just unfortunately they feel forced to over leverage their debt to maintain or sustain something. And it's very sad, but people do this towards the end of really big or long or strong bullish phases. And then you kind of get the remains, right? What happens after that is not normally good. Excuse me. So really close to rolling over in transports. Again, energy is its own thing, but financials and transports now both like threatening to roll over. Yeah, I'm concerned because I always keep an eye on those sectors, especially. And that those to me, energy is its own thing. But yeah, you can't rule out that trek to the 50. But that would make sense, and then that could become the real bounce area, right? It could be the false bounce area. It could be no, there's news and we just plunge right through, despite the fact that we probably would be oversold when we got there. So, this is going to be important to watch along with financials, just for the overall kind of health reading, along with XLP and XLY. Again, I'd like to say that energy is a part of that, and it still very well may be, but it seems like the reserves issue is weighing, on the lack of reserves, that's weighing on energy, I should say, propelling energy, fueling energy. So that's that. Now, XLB, this one to me, right, base materials, I was getting excited about this thinking, okay, if they somehow manage to pull this off and materials and industrials are going to go, this is going to be a great spot, right? But unfortunately, right, that looks a lot like the other things we've looked at. And so to me, I think another thing that we could just drop in on this one is that you're already through support. If my eyes are not deceiving me, I guess it depends on where I draw it from, but you could even say that even if I give it the benefit of the doubt, I draw off that wick, yeah, it's still right below, and you're at 51, so you have more room to go before you become oversold. So yeah, I still think there's corrective action. You could see RSI has been deteriorating in there. You just have to wait, and then use your either SMAs, flat lines, or support lines that I just drew, things like that, to trigger your entry. And hopefully you draw something aggressive, or you have a technique that's very aggressive that you fall below, or you start trading on divergence and a break of some nearby support just on a price action basis. Don't want to go into all that, but you get the idea. This to me too, this was pretty interesting. We had FCX in this one, got a nice little pop out of it, maybe a couple others, but there haven't been many themes in UOA. It's been all across the board. Fortunately we had like IWM and some spiders put buying, things like that, and some ETF put buying. One of those was in here. And, this is a very strong sector. We were even saying that last week. In fact, right, earlier in the week, it made a new recovery high. And this is one of the reasons, right, if you see the room it had to that upper Bollinger, that's one reason why I kept saying, like, as much as I have a hard time believing that they could pull it off, I can't rule it out, because if they got the Apple scamper to happen to the upside instead of the downside, yeah, a lot of these stocks might have really gotten juiced and used up some more of that room that I thought they had to run, if that scenario played out. But of course, the other scenario played out, became sell on news. Apple wasn't well received, and the whole market used that as an excuse to sell off. And that's what we also said in macro measure. But look, you're losing the 20 in a big way here, right? And so we have a UOA based trade on in here, as well as XHB, for that reason. Again, I felt like these things got a little absurd, with how they were still acting. And there was some technical deterioration. and I felt like the sweet spot was ending, and that we were seeing sell on news, and so we got prepared just in case once we were through Apple, Amazon, and the EPS deluge late in the week, that if they decided to go risk off, which they did, we'd be ready. And then this thing started to drop. So hasn't really paid off big yet. Hopefully it's in the early stages for players that are still in there, and we start to see more corrective action. But again, when you're at 50 rounded in the RSI, you're not really that overdone. So yeah, there's room to go there. Now, the only caveat I would add is that the 1 hour RSI is about 30. So you're already oversold on an intraday chart that's worth keeping an eye on. But that's why the early part of this week could be tricky, where some things could get oversold quickly and they might try to put a little relief rally together. But overall, I think you get the idea that, I still think that relief rally, without news that would really change the dynamic, that relief rally probably is only that, a relief rally would be my best, most likely scenario. In terms of CAT, this one to me was a good idea. I wanted to get trade ideas in both directions, but I was typing the idea up on this day and they just kept screaming it in my face. I think it was that day. And so I was just like, forget it. Like I could not get just every keystroke seemed like CAT jumped another 25 cents in my face, because I thought there was a trade in both directions. I actually thought it could get a little more overdone, because that's how these guys roll. And then eventually I thought if the market did roll over, once we were through Apple and everything, and we could finally get selling. And interestingly, it would have worked out on both sides, but I could only get the bear side in. I can't remember where we were on the trigger, but I think it was like 288 and change. I think I used the close of that particular day there. And I think I may have been typing it up this day. I just couldn't get it in fast enough. It just kept jamming. But anyway, got some good reports on that. Remember, there's a nice gap here. And remember what we say about gaps, like within 4 to 5 days, that's when a lot of gaps close, if they're going to close anytime in the near term. And if that doesn't happen, much like back here, right, it just got so far away from the gap, it became unlucky after 5 days. It became unlikely after 5 days that gap would ever close as soon. Not that it's impossible, but soon. And you kind of ignore it and just go with the trend. And then that, you can see that really worked out well overall. But yeah, this one, right, you have the gap here. So you're only 3 days after. We say between 4 to 5 days. So yeah, I mean, if there's a rough start, I still think this thing could trade down towards here. Remember, I wouldn't trade it for gap closure to the penny, which would be a high of 265.21 on that day. If you're smart, unlike Fredo, if you're smart, you should probably be somewhere near this 15 SMA. What's that? 266.70 gives you an idea. So, there's still a little more downside in there, I think. I hope the folks that are riding that one still do well. So we had XLI, we had CAT, another counter trend. Oh, by the way, so this is what I wanted to mention on this one. This is just a little bit of like a thing that helps me. This 3 standard deviation at Bollinger, you can see how far out of that, right? And go look at that. I have it set to, I always run mine on the 100 SMA as the spine for the Bollingers. And you can see, right, when you get wide bands, and you can't even see the lower band because it's wide, kind of wide right now, gives you an idea. That's a pretty wide band. It's not narrow like it was back in this point. So I take my Bollinger Band excursions more seriously when they're set to 3 standard deviations and it's a fairly wide band. That's one compelling reason for me. And I thought this was overdone. I thought that this jam job, right, from 265 nearly $30 was a little excessive, I guess you could call it, in light of what I thought was happening in the market at large, in light of what the dollar and the TNX were doing, and then the VIX started catching on. So yeah, that became like a little bit of not so much of an arm twister to put a counter trend idea in. I felt like it could become sell on news, and that's fortunately what developed by the end of the week. So I hope a lot of our traders did well with that. I did the same thing in Roku, and I'm not even going to explain why, because you can all see why I would really think the same way in that case, right? With a 70, even, on this day, it backed off the high small on the close, but it still managed to get a 76 reading in above the Bollingers. And the Bollingers were not super wide. They were certainly wider than they'd been for months. So in a relative way, they were on the wider side in a significant way, in my opinion, in the context of what's been happening in this market with sell on news. And so we put another bear in there. And I think that also, to me, like, that makes a lot of sense for that to fall back towards this area here, right? So I think there's still some downside there. Now it all depends right on what the market does, weekend news, you get the idea. But anyway, that was another one there, excuse me. So what else can we look at? Let me think about this briefly, because I think we've covered a lot. I covered XHB in relation to XLRE, covered some of those ETFs. Oh yeah, we can take a look at the copper futures. And this is something we were watching for to see if it could break out. And that would be a good sign, right, for the global economy that things are improving. I don't think they are. But again, I'm going to defer to the market and the chart and Thinkorswim's. And you could see that they failed. We did have that breakout attempt and it failed to sustain and carry. Right. So now you're back in. This is how things can change, right? Like people have a problem with a lot of technicians because they're willing to be bulls now, and then people will say, well, you were just a bull last week. What happened? Well, for me, I look at it like the market changed, right? Like if you start to see something that fails to break out and now it's about to lose all SMA support and stocks are getting heavy, like, yeah, I'm going to change my mind, right? Because not that I was like pounding the table, but you have to say, like, it kind of surprised me, but I'm like, look, got to give them the benefit of the doubt, but they're very good at this, right? There were a lot of stocks early last week that had tremendously bullish charts that if they could have just gone a little further, taken out a little bit more resistance in a bullish market, I think they would have roared, really, really roared. But at turning points or critical phases, that's what you see a lot of, things right on the cusp. And then that does lure a lot of people in that don't wait for trigger level supremacy, right? A better way to go about things, I think. And then you get these false breakouts and you get reversals, and people that are not disciplined get smoked because they don't pull the trigger and say, look, this isn't firing the way it should. Usually when you get a good breakout, it's hard to get in, right? It's not easy to get in. There's not a lot of stalling, not always. It's certainly not the case always, but so we looked at that. We did not look at oil. I should have looked at the oil futures when we were there looking at XLE. So let's do that. And then we'll probably start wrapping things up. Probably one of the longer sector situations we've done, but I feel like, look, it's a turning point. I know a lot of people do not like the way that I do so many things. They just want like really short technicals, and we're gonna have to work on that. So it's just the way that it is. Like you kind of like are what you are, and I am not a McChartist. I don't do things on a fast food basis when it comes to the chart work that I do, and I wish I could, but I've never felt confident enough to say like this is all I need, and that's it. I honestly feel like for a change, like one thing that really pays off in investing is to really be thorough in your charting, and then also understand the context. And it requires a lot of work to do that, but I think it only helps you once you synthesize it all. It's just my way of looking at it. But look, hard to argue, right? I mean, you made a new high Friday, right? You made a new high, and I think this thing is on the cusp of you're on the cusp of a breakout. So this would again be good for energy stocks if we can get going and rip through these highs that have really kept this thing in check now, going all the way back to about there, right? So what's that? That's November of 22. So we're looking at nearly a year. If you can finally break out and break through here, probably end up being overbought not too long after if you go that way. But if they are able to break it out, bring it back, hold it near there, and then go again, this could be really turning the corner. And I would like to think that's good for the global economy. Maybe it will be. I don't think it is at this stage. To me, it's more of another kind of taxation policy that starts hurting American consumers who are already, I think, pressed. So with reserves at 1985 levels, I think that was not a really good policy decision. But again, that's, some people would argue the other side of that. I just don't see how you drain your reserves when it seems as though there's a lot of risk ratcheting up in the world in terms of geopol, right? We all know about Ukraine, the whole works. It just, and it's just not a good place to be, right? And you really would rather load up your reserves, I think, when you're at these lower levels, not wait to sock it to the American consumer. But that presupposes that all these people have what's best for the American consumer and voter in mind, as opposed to not. And that's probably not a good assumption, to be honest, but don't want to get into that kind of stuff. I know it upsets a lot of people, but again, I don't think it's about your political party. I think it's about us and them, regular folks versus the ruling elite class. And they're just, they're not our friends. Anyway, this is it. You can see this consolidation has been long and painful. The best case scenario is that the tide finally turns, we finish strongly, break out of this. And I hope there's a nice little sustained uptrend that we can trade, but more importantly, that really starts to be one of the early signs that this recent bullish phase that we've been in, this now seemingly correcting, that is the real deal, and that the global economy is sort of licking its wounds and on its way to resuming its normal course of business, which would mean that things start to pick up. Really hope that's the case, because I hate to see people struggle, especially due to reasons that are beyond their control, that they have nothing to do with, that they pay for the poor ethics and poor decisions of others. On that note, that somber note, we're going to have to wrap it up. I want to thank everyone for tuning in. And again, I don't sell anybody on what we do here. I probably should sell people on what we do here, but I don't like to come off as, neither does Ryan or Greg, that we're bragging or pounding the table. It's just not the kind of people that we are. We're all raised to be, humble and respectful of people and what's going on. And overall, but anyway, the point I'm trying to make is there's been a lot of great stuff happening, and I think Phoenix portfolio remains the place to be. If I were a subscriber, I would kick the tires on that. I think with all of our services, there's some sort of like, if you don't like it, you don't have to stay in it type of a deal. I would talk to your sales rep at Market Rebellion, because this could be big, right? This area, this general area and time or window in time that we're in, this could look back on this and could be big. Don't know, of course, but just has the recipe for big changes potentially, even just through the end of the year, where you could see what we expect: corrective activity for a few months, back and forth maybe, and then you get a good resumption. But that would really be good, because you could, Ryan does a good job of covering that. I'm in there with him on the Phoenix webinars. And that class is going to get more and more interesting, because we're going to be doing more and more trading in there and tracking things. And it's long-term oriented, more of a lifestyle trading situation, trying to work it into that. We just need some more personnel or firepower to really be able to do that, because we're spread very thin. We barely cover what we need to. Unfortunately, it's just because the markets remain challenging, we have a lot on our plate. But if we can get everything in place, and that it could be a very interesting service. But again, portfolio hedging, doing things a lot differently than the conventional ways in terms of positioning, volatility positioning, all those kind of things, right? Ways to be a big bear if you want to, that are not too painful, right? It's things like that, that allow you to adjust, that you actually plan to adjust in the future. It's not like it's initially you put an idea in place, but you actually plan to adjust it at the right time, right? And so it sort of puts you where you need to be most of the way there. Then you make one morph and you're now all the way there. And that's the idea, that you've got it in place. It doesn't hurt you until you decide to morph in a big way. And then when you morph, hopefully you get that aggressive downside movement that you were expecting, and it really can pay off dramatically that way. So just wanted to share that. Not really a full-scale sell, but I feel like it's probably the most overlooked thing that we do. And it's probably one of the most helpful things, I think, that you can be involved with overall for the long term, because it's not just about short-term trading, which in and of itself it can be very lucrative, obviously, but it's just more about, you can even use it for strategies that just protect your portfolio overall, strategies to protect you within certain stocks. You can do things that are really cash outlay free, that protect you, that we cover in there, and get people comfortable with how to morph your longer term positions at the right times and why. There's a lot that goes on, and it's very different than, say, the UOA trading that we do, or the just pure momentum trading that we do. So on that note, I'm going to wrap it up and say thank you to everyone for tuning in. I hope something I share with you this week helps you this week, and or helps you at some point in the future. I wanted to let you all know, of course, I'll be in touch in the usual ways. I would say stay nimble, be prepared for singles and doubles, do the best you can. I think volatility is set to pick up, and you're going to have to just deal with that, maybe that more of a back and forth market, more than the trending market that we've got over the next few months. We'll see if it pans out that way, but that's what I'm going with for now, until further notice. So everyone take care, have a great conclusion to your weekend. We'll see you in the webinars and cocktail hour and so on and so forth this week. Thanks.